let's dive into, clearly we call the show the What is Money Show.
Okay.
We like to go deep, philosophical and all that. Government bonds are an interesting one because everyone's heard of them, but I don't think anyone knows what they are hardly. Maybe a lot of people understand that they are debt, but it's a very unique class, right? It's a unique asset class, it's a unique category of debt, and it's one that doesn't often get repaid in my analysis of history, at least.
That's true. When you have a growing debt burden, mathematically, government debt does not mature. It has to roll over. So a 30-year bond becomes a 20-year bond, becomes a 10-year bond, becomes a 10-week bond. When it matures, the government just refunds it, reissues a term to maturity. But you know what's the good thing about bonds is they are 100% math. So there's no subjectivity to them. They are an obligation. They are a fiat contract. And in that sense, that's where the trouble starts. They are a fiat contract. So no subjectivity, 100% math, which is what I like about them. But then there's no arguing with the return outcomes and the return profile. In equities, you have growth assumptions. You have people that price growth to the moon. As we know, equity guys tend to be optimists. And the funny thing is, bond guys tend to be pessimists. Bond holders, not a lot of good things happen to bonds. You either get repaid or the bond defaults. And those are the two binary outcomes.
Right, yeah, and you hear from a lot of people that the bond market tends to tell the truth, whereas equities can get...
Here's the neat thing. There was a time when rates were not manipulated that certainly the bond guys seem to be up on the... more up on the macro events than equity guys. Now with QE and yield curve control in various countries, the signals coming from the bond market aren't quite as open as they have been historically.
Right. So is that the major problem and the feature that distinguishes government bonds from all other types of debt, is that countries have a monopoly on the currency so they can just print new units of currency to pay the debt?
You know, I mean, even though you would think, and the truth is, if you define default as not being able to repay the obligation, that chance of default is infinitesimally small in the case of the United States. It's not zero. And to prove my point, I will just tell anyone to go and look at what's called the credit default swap market, which is an open market insurance contract on the default probability of the USA. But the reality is it's infinitesimally small. Now, there are 180 other countries in the world, fiat issuing countries. Plenty of them do default.
Right.
Some of them are serial defaulters. I like to say that in my career, Argentina has defaulted 4 times. And the funny thing is, that means if you bought a 30-year bond 30 years ago, and not only did it not make it 10 years, it made it, on average only 7.5 years, right? Before it defaulted. That's the unfortunate reality of lesser credit quality countries. Everyone always says about the USA, oh my goodness, the USA is in big trouble. Well, let me tell you something. If the USA is in big trouble, Canada's in big trouble squared. I often say that Canada will default 10 years before the US defaults. Now, ultimately, they will all default. It's pure mathematics and pure history. But, the USA is the world's most secure sovereign borrower. In close second is the European Union, but that union is made up of some haves and have-nots, right? And so government debt is prior to concerns about default, it was 100% focused on inflation expectations. My thesis is people are going to have to start worrying a lot more about the default components of the return and the compensation you get. So the coupon on the debt compensates you for risk. That coupon generally has been a reflection of forward-looking inflation expectations. But now I argue you're going to have to start pricing in default concerns.
Right. And some of that default concern I would imagine has to do with Bitcoin's emergence, right? The people have the
Interesting,
ability
you know,
to opt out.
I don't think that the large players in sovereign debt have made that link yet. I would make that link, and I know you make that link. But we still have to understand that the sovereign debt market is ruled by guys that, like, I'm old, right? I'm 58. It's ruled by guys that are still, 15 years older than I am. Very crusty old portfolio managers with a lot of experience. But let's be honest. Interest rates over the last 40 years have done nothing but go down. And when interest rates go down, bond prices go up. That's the pure mathematics of it. We're in a new paradigm right now. Interest rates hit a base of slightly under 1% on the US 10-year. I don't believe they're going to go negative. There's people that think they are, but let's even think about what that means. If a bond has a negative yield, it's no longer an asset, it's a liability. You give someone your money and you get less money back.
Right.
Hey, that's a great investment. Well, that's what negative yielding bonds are. So anyone who's hoping that happens, I think they're pushing on a string. Right now, 10-year US rates for a number are at 2.5%. They did get slightly under 1%. When I started trading bonds close to 35 years ago, the 10-year rate was 14%. Wow. It just gives you a different idea. Now, here's a really cool thing. Inflation then was lower than it is now.
Right.
And the 10-year rate was 14%.
Right.
With CPI at, call it 8% right now, if you believe that to be the number, but let's just take that as the number, and the 10-year rate at 2.5%, you're earning a negative real return. That means subtracting out inflation of negative 5%.
Right.
When you own a bond. A U.S. Treasury bond, at least in 1985, let's say, when the interest rate was 14% and inflation was, just to make the math simple, call it 8% like it is now. At least 14% minus 8% gave you a 6% positive real return.
Yeah.
That's what bonds are. Again, a fiat contract. Let's not mess around. There is no subjectivity to this.
Yeah. Yeah, well said. So let's talk about a couple of those points. So one, inflation itself. I've often described that it's really just governments implicitly defaulting, right? This is the expansion of the currency supply to pay off these obligations. And so the cost of that default is effectively being externalized onto the productive market society. So is that how you look at inflation? Because I know we often talk about, it used to be a good proxy for inflation expectations, but to your point, now the default's more on the table, explicit default.
Yes.
That seems to have changed.
What a great explanation. And quite honestly, I follow a lot of your stuff, but I have never heard you explain it that way. It's a great way to look at it. I mean, there has never been, an explicit default is when, you can't make your coupon payment. The reality is, though, when you can print money, you can just make that payment by printing more money. Now, you take Venezuela as an example where they were able to print the money, but the money ended up on in the garbage on the curb. In the USA, that hasn't happened yet. I don't want that to happen, but the risk is rising on a daily basis. An implicit default, 1971, right? That was an implicit default. And then when you talk about inflation, and I'm thinking out loud here, the cool thing is, I like the way you explain it. Capitalism with banks that are 25 times leveraged, which is what our banking system is, which means for every $100 of loans that they make, they only hold $4 of equity capital. And the other $96 comes from depositors' money. So that's your 25 times levered, right? They need inflation so that the collateral increases in value. The collateral backing the loan needs to increase in value because they're only holding 4 cents on the dollar.
Right, in nominal value.
There you go. And that is what banking is. And as Henry Ford said over 100 years ago, something along the lines of, if the average American understood how the commercial banking system worked, there'd be a revolution in the morning. So Henry Ford knew we needed Bitcoin. I knew we needed Bitcoin in 1998 when I first started working in the banking system. That being said, it didn't exist. So when I finally found it, I was like, oh my God, I've been looking for this for 30 years, plus or minus, because I found it in 2016. But, coming back to your point, inflation is a tax. Jeff Booth talks about this really, really well. But it needs to happen predominantly because the collateral value for commercial banks needs to have that upward trend.
Right. So the debt-based system requires fiat currency expansion just to increase the nominal value of the collateral so that the system is sustainable.
Helps. You know what? As risks go, that's a lot less risky than the other alternative.
But that expansion is taxing the productive economy, so it's pushing all these market actors further out along the risk curve,
there you go.
Dispossessing the economically vulnerable. And historically, these systems collapse, right? Like
history speaks for itself.
Yeah.
Correct.